Hello, everyone. It's Brad Thomas, and welcome back to the wide-moat show. Today, I'm joined with my co-host, Nicholas Ward. Nick, it's good to see you today.
Yeah, good to see you, Brad, and welcome everybody to the channel.
Well, I like your look. You've got the beard back going again, so looks like you're getting ready for some summer vacation.
Yeah, we'll be, and actually 2 weeks. We're taking a vacation, so I'm looking forward to that. I'll probably need to shave before then. I don't want to be have beard tan lines. That's not a good look. But if the beard's growing, it means we're making money, so that's a good thing.
Last week, we covered kind of my wheelhouse, some of the most exciting companies that we cover in the real estate investment trust. And today, we're going to let you kind of take over the reins and talk about one of your favorite asset classes, technology.
Yeah, no, looking forward to it. And I do want to thank everybody. Brad, your video, we had a ton of great comments. People obviously really love the REITs, the high yield, areas of the market. So, I guess now's a good time to say, please like and subscribe to our channel, and please leave comments. As you guys see, Brad or I or the wide-moat team, somebody will respond to you, and we really enjoy the back and forth that we're having with our community. And today I am going to focus on tech. I am kind of more of a growth investor, I think, than Brad is. I kind of like to think of us as kind of the Warren Buffett and the Charlie Munger kind of dynamic that they had. I think, and correct me if I'm wrong, Brad, but kind of when you got into investing, I think Chuck Carnival, Mr. Valuation, who invented the FastGraphs that we show up for you guys, he was a big inspiration for you. And Chuck is the consummate value investor. If a company does not have a wide margin of safety, he's not going to invest in it. And that's kind of how Warren Buffett started out. He was looking for the cigar butts. He was looking for the cheapest companies, and he wanted to take advantage of their big margin of safety to make money. And then Charlie Munger came along and eventually kind of convinced him that value is great, but quality is ultimately going to be better in the long run, that it's okay to buy a wonderful company at a fair price, as opposed to looking for those cigar butts for the big value. Charlie kind of convinced Warren, and then that Berkshire kind of changed how they do things, 20 years ago or so. So there's nothing wrong with either thing. I think Brad looks for value more, and I'm typically looking, I think, for very reliable growth and quality. That's how I would sort of differentiate the two of us.
Yeah, and look, you just can't ignore technology today. I mean, it's driving this whole world, and there's tremendous wealth creation in technology. So we just can't ignore that. And that's one of the great things at wide-moat Research is we have a very broad, suite of coverage. And so, Nick, let's get going here. Let's talk about some of your technology trades.
Yeah. Before we get into that, I do want to say, I hope people that are watching this show, a few of them what would have been on this list a few months ago are no longer on there. I mentioned GE Vernova, I mentioned Vertiv, I mentioned Microsoft several times on this channel. I looked it up. Since their lows, GEV's up 79%, VRT's up 91%, and Microsoft is up 33%. So listeners that happened to buy those stocks at the time, they did very well, as did I. I was buying those stocks very heavily, back in April. Now I have to find other things, because when the stock's up 90% in a couple of months, it's likely no longer a great value. And that is the case with a VRT. I love that at 60. I'm happy to hold it at 120, but I don't want to buy it at 120. And before we get into tech, I do want to mention there's some very interesting stocks that almost made this list. The healthcare names, I have a list here: Eli Lilly, Novo Nordisk, Thermo Fisher, Danaher, United Healthcare. There's a lot of very interesting value in that area of the market, but that's not where my focus lies, because it's so hard to predict. I don't really understand their pipelines. I hate patent cliffs. That's such a difficult thing to kind of navigate as an investor. So I didn't go to healthcare. Utilities, NextEra and AES, those are really beaten down. High yields, I didn't really like those as much right now, because their growth levels aren't quite where the stocks that I'm going to talk about today are. And then the same thing goes for companies like Pepsi or Hormel in the consumer staple space. When you look at a 52-week high, 52-week low chart right now, you'll see a lot of consumer staples and food companies down there near the 52-week lows. However, they are struggling to grow, at least in 2025 right now, because of a lot of disruption that we're seeing in the economy. So that's not where I went. I went with companies that provide free cash flow, huge free cash flow. That's where my focus is. I don't even consider myself a tech investor, although if you look at my top 20 holdings, I think 18 of them are tech stocks. I think of myself as a free cash flow junkie. So now we're going to arrive at the first one. And excuse me for looking down. I have a lot of notes here. I'd rather get it right than then screw things up here. And that's Alphabet. This is a company that has been beaten down a lot recently because of fears of AI disruption. Everybody uses Google. Alphabet's Google's parent, if you weren't aware. So everybody uses Google, Gmail, Google Search, all their products, and they're all free. And the reason that they're free is because they make money with advertising. The problem with that is a lot of people think Chat GPT and all these other AI chatbots are going to just destroy search. And when that happens, obviously Google's advertising business is going to disappear. And so the stock is really cheap right now. So I'll get into the numbers, but I guess before I do, Brad, do you have any thoughts on that? Do you worry about AI disrupting Google? Do you use GPT chat? How does that work for you?
No, but I mean, certainly, you can't overlook AI. And I think this is definitely a sector that everybody should be familiar with. And even if you're not investing in it, you have to understand this is transformational to wealth in this country. And so, obviously I'm more in tune to the real estate, the data centers, which are the driving mission critical elements to AI. The other thing you mentioned, utilities. They're boring too. But again, there's some really terrific utility companies that power these data centers, which obviously powers the AI. So you've got to have all those pieces together, right? And so you can own the real estate, you can own the energy source, or you can actually own this technology. So I'm excited, Nick, to pick your brain a little bit today.
Yeah, that's what we have here. Well, as far as free cash flow goes, I looked it up. Google generated 18.5 billion last quarter alone. I mean, there's a bunch of companies in the S&P 500 that don't even do that during a calendar year. During the last 12 months, Alphabet has generated 74.9 billion in free cash flow. Last quarter, they used that to buy back $15.7 billion worth of stock. They just started paying a dividend. The dividend grew, I think, 5% this year. So it's slow growth, but there's so much uncertainty in that area of the market. I think, in 24 years, we're talking about a dividend aristocrat here. When you have these types of cash flows, obviously the landscape's going to change so much in the next 20 years, but they have such a big cash hoard. I just have a hard time believing that somebody's going to knock a company like Alphabet off. They're working in driverless cars. They're known for their search, but they own Waymo. They own all sorts of exciting things. And that's what I like about this company. They're highly diversified, even though their revenue stream isn't. The revenue stream mainly comes from one source, but long-term, I think they have what it takes to pivot. And they have a 34% operating margin. All these companies, that's something you'll see that they have in common. Very high margins, which is something that I look for. I look for companies that generate free cash flow, which requires high profit margins. And then, as you can see, companies that are growing them reliably. I'm not happy just to own a very high yet stagnant free cash flow level. I need to see that free cash flow compounding, because that means that the dividend will compound. So we'll throw up a fast graph on the screen, and you can see here Alphabet has been growing its earnings very reliably. Same thing with free cash flow, as you can imagine. During the last 20 years, there's only been one negative year, and that happened during COVID, during 2020. That's something you'll see on all of these fast graphs. A lot of companies struggled to generate profits during 2020. The world literally shut down there for a few months. But since then, back to double digits. And I don't think that's going to change anytime soon, despite kind of all of the negative commentary surrounding search and what's going to happen with that. Moving forward to our next pick, I kind of call Alphabet growth at a reasonable price, GARP. That's an acronym that people use. I'm going to go to Nvidia, which I'm just going to call a wonderful company at a fair price right now. And that may surprise a lot of people, because Nvidia has risen so much in the last 5 years. I think in 2017, I was buying shares at like $2 a piece on a split adjusted level. Now they're up, $150. It's crazy. But as much as the company has come along as from a share price perspective, its earnings have came just as fast. And there's even an argument to be made that Nvidia is cheaper now than it's been during much of the last 5 years or so. We'll throw up a fast graph on the screen. As you can see, the stock's trading for 41 times blended PDE, which basically means this year. But if you look at a forward basis, they're trading for less than 35 times earnings, because they're expected to grow at 43% this year. They're expected to grow another 33% in 2026. So if you put that 35 times multiple on those 2026 earnings, we're looking at a $200 stock. Stock's at $140 right now. So it's still massive upside. As you can see on the screen here, I'll kind of highlight it. 35 times forward is $150. Nice round number. I'll call that fair value. Maybe you do 30 times. If you're looking at 30 times, it's a little less. It's down like near 130, but not still kind of right where we are now. So after all these gains, I think NVIDIA can be called fair. And I love owning companies. A company's growing at 40 and 30%. I'm happy to pay 30 times for that. It's a 1.0 peg. This company has a very small dividend. It just increased by 150% last year, though. So I think in 10, 20 years, sure, the yield is basically non-existent right now, but I think long-term shareholders will be grateful that they do hold. Like I said, I have a yield on cost north of 1% on these shares on my personal position, just because I've owned them for nearly a decade. So NVIDIA has certainly changed my personal life, up 10,000% or something like that. But I'm still buying shares today just because I like the company's growth so much. So Brad, I know NVIDIA is maybe not being your wheelhouse here, but I'll open up the floor to you. Do you have any opinions or comments on this company?
Well, I want to ask you this question, not specifically on NVIDIA, but just these hyperscalers in general. One of my our free articles this week, I just finished writing it for wide-moat Daily. So any of you watching, please visit us at wide-moatdaily.com. You get all the free news each and every day, 5 days a week. I just wrote an article on the data centers, Nick, and just highlighting all the data centers and there's actually many new data center entrants. Realty Income owns data centers, corporate office properties owns data centers. Prologis has gotten into the data center space. American Towers in the data center space. So a lot of REITs are getting into data centers. So a lot of new supply. But what about demand? Do you think these hyperscalers, do you think it makes sense for these hyperscalers to own versus lease? Because I'm of the opinion I think they should lease, obviously. But do you have any thoughts there?
I don't know if it matters. I mean, I think they'll probably go the lease route, which is what companies basically do with every other type of real estate that they own, office buildings.
Well, with these companies some of them are starting to pay these dividends. So I'm just curious. I know they're not very high dividends like we see in the REITs or the MLPs or any of these other high yielding categories. But do you think it makes sense for them to pay dividends? I mean, obviously, I'm a very pro dividend, but they've got such large requirements for capex to reinvest in those companies. Does it make sense for these companies to pay a dividend?
I think it does. I mean, like I said, Alphabet generated $74.9 billion in free cash flow last year, so they got room to pay. I mean, they could 5x their dividend right now, and the payout ratio would still be like 25%. Same thing with Nvidia; they're at $26.1 billion free cash flow last quarter. That alone, 61% gross margin, and they said that would have been 71% if it wasn't for the kind of H20 China issues, where the president just said you can't sell these chips to China. So they had huge write-downs, $20 billion write-downs, I think, over the course of this year because of that. The issue with this company in particular is people are wondering, how long is it going to last? Like you said, our competition, if you have a 71% gross margin, there's obviously everybody's going to pile into that space. Everybody wants that margin. This is one of a few companies in the market that has it. So every company that works on semiconductors is trying to figure out, man, how can we just take a little bit of market share from NVIDIA and just generate our own 50% plus margin? We haven't seen that happening yet. They have such a big lead that it doesn't seem to be knocking them off. Honestly, the Chinese companies who may or may not be knocking off their tech, I don't know. You hear about kind of IP espionage all the time. Huawei, I think, is probably their closest competitor, but they're still lagging behind. AMD, a lot of the other kind of US competitors aren't quite there. So I feel comfortable owning shares and even buying shares. I think the lead is so big right now for them. And I don't see demand going anywhere. I mean, I know Apple posted a white paper yesterday that said that AI reasoning isn't really real and that it's not as good as people think it is. And really, it's just a lot of companies spending a whole lot of money and using a whole bunch of energy and compute power just to give out answers that aren't that great. That may be true. I think Apple may just be using that as justification for why they're not investing as heavily in AI as all the other hyperscalers. But at this point, we're in this kind of race to see who can dominate AI. That can be a scary thing. There's some people think that's going to like end the world and humanity. There's other people that think that's going to be in like a post-scarcity utopia. I imagine, like always, it's going to be somewhere in between. But it's a huge race, AI race globally. We're seeing nation states, companies, governments, universities, everybody's investing into this stuff. So I think it's fine. And every data center that gets built, NVIDIA is a beneficiary because their chips dominate the market. I'm sure there are some data centers with no NVIDIA chips inside, but 80-90% of them are filled with these chips. And that's not going to change anytime soon. We have two more picks. I'll try to be quick here. Another one is Salesforce, another AI play. They are a back-end enterprise software company that is using AI to try to translate into basically taking humans out of the equation longer term and just using AI bots to do the same work. That's expected to increase their margins. They have 32% margins right now. That's expected to rise as they kind of AI takes over. $6.3 billion in free cash flow last quarter. They're guiding for 9 to 10% free cash flow growth this year. So Salesforce isn't growing as fast as the other companies I talked about, but it's a very mature company. It's a well-established company, and you give me 30% margin and then double-digit growth prospects. Pretty happy to own that. As you can see on the fast graph, it is a little cheaper, 25 times right now. I think that's probably about fair value. It was trading for 20-ish times not that long ago, but its stocks have recovered. But it's still way off the highs. On the fast graph, it's 36 times at the end of last year, and you could see the 10-year average is 59 times. So the stock is at a massive discount to where it has been. Its growth is slowing, so it's getting that sort of growth, the kind of mature company premium as opposed to the growth company premium. That's a hard thing to figure out because you don't know where it's going to settle. But like I said, 30% margins, 10% growth. I think 25 times is fair. So Salesforce is a company I've been buying during its recent pullback. And unlike some competitors, for instance, ServiceNow, I like that company better. It's growing a lot faster. It's about 1/5 the size though. So it's easier for it to grow faster, but it's up 51% from the kind of tariff lows, whereas Salesforce is only up 13%. So when you're looking for a kind of relative value in this AI software space, I like Salesforce right now. I was buying ServiceNow, ticker symbol NOW, very heavily a couple months ago, but after a 50% run, I don't find that nearly as attractive. And the last thing, and Brad, I know you were in New York last week with Bill Ackman. One of his most recent holdings, I think he just entered the position a week ago. I've owned this position for about a decade, Amazon. It's a little different than every other thing that I've talked about today because they don't have that perfect free cash flow trajectory. Theirs is very choppy. They have shown over the years that they can literally just flip a switch. Hey, we want to make money? Sure, do that. Hey, we don't care about making money. We don't have to do that either. And they invest so heavily. They've built out logistics. They own more airplanes, I think, than FedEx at this point in time. It's crazy. If Amazon wants to do something, they go all in and they dominate that market. And I like that as a shareholder. This is one of the few companies in the market that gets the benefit of the doubt. If they're not making money, but they say, hey, we will, people believe them. They don't believe everybody else, but Amazon has such a history of doing so that I think that's fine. And here's a chart. And I think this is where a lot of people get Amazon wrong. And I do have to give Adam Gallus, one of our former colleagues at wide-moat and somebody we still work with at Dividend Kings, he evaluates Amazon based upon its operating cash flow, OFC. So this fast graph here, you're not going to see EPS, you're going to see OFC, but it's such a great pattern that formed that I started to do it too. And I think Adam's right on. As you can see, for years, the company was trading kind of following that kind of 30 times OFC chart. Now, post-COVID, it's kind of stuck with the 20 times. So that's a pretty big valuation drop from 30 to 20 times premium, but the stock is right there now, and it's expected to grow 20% a year, every year, basically moving forward. So if you have something compounding at 20%, that's a recipe for great success. 20 times this year's growth, we're looking at $240 a share. Stock's at $216 right now. So if that trend holds up that you'll see on the fast graph here, big upside for Amazon. So that's my final stock pick. And the last thing I want to do, these are obviously growth picks, somewhat speculative. Some may say they do require long periods of time. If you don't like that, if you're more on the Brad side of kind of the high yield spectrum, I honestly just like short-term U.S. Treasury notes right now. I own a lot of ticker symbol BIL and SGov. Those are just ETFs that allow you to own T-notes. I don't want to build bond ladders. That's just not something I want to spend my time doing. I'm happy to pay an ETF a few basis points to do that for me. But the 3-year T-bill yields 4.35% right now, basically risk-free. I mean, I guess there is some risk that the U.S. defaults and you don't get your thing, but I don't think that's going to happen in the next 3 months. And then what I do is I sell cash secured puts on blue chip companies that like these growth stocks with that money. So in Fidelity, if you stick your money in a money market, you get this 4% yield, and then you're able to sell these cash secured puts. So you can't trade that money, but if you sell, a 90-day option, you get the 4% yield on your cash. You get your premium that you get from the option, which I usually try to do at 20% annualized. And Stephen Hester, our option guy, does this at wide-moat. There's a great way to make money with the intelligent option investor. What's it called, Brad? Sorry, I haven't even.
Intelligent Option Advisor. I think
Advisor. There you go. I knew that was wrong as soon as I said it. But options are a great way to make money, and I like it because you can pick a stock. Say, hey, Nick, I don't like Amazon at 216. I think it's too expensive. Well, you can say, well, I'm willing to buy it at 190. Well, then you can sell that cash secured put at 190. Probably collect, a few $100. You have to buy 100 shares, so you have to be willing to spend $19,000. But you can probably collect like $300 in the meantime. And then if it doesn't go to 190, you just get to keep 300. If it does, you get to keep the 300 and you get to buy a stock at a price that you like. So that's what I do with my cash. And I've been building cash reserves. I'm happy to collect that 4% yield and then kind of pick my spots and pick these growth companies at prices that I like. I don't have to let the market decide the price. I decide the price, and then I get to collect premium in the meantime. So guys, that's it. That's my video. So Brad, any closing thoughts? And then obviously I will be in the comment section. If you guys have any questions, feel free to ask and I will chime in below.
Great. No, Nick, great job. And it's great to have this diversification. Again, we need to do more of this. Again, I think it's all about diversifying and giving our subscribers, our audience, frankly, just all of the opportunity set that we have, because we've got such a great platform and great analysts here at wide-moat. Nick, I want to ask you one thing real quick on Amazon. I got to touch back to real estate. They acquired Whole Foods, which is a grocery chain, real estate play. They lease most of those Whole Foods facilities. But again, Amazon appears to me, in terms of moat advantage, would you say Amazon has one of the widest moats in that technology universe? I mean, they just seem virtually unstoppable, and it's been such a disruptive force, starting from the book sales industry, and it obviously shook up Barnes and Noble and that whole entire book chain. But it's just been an amazing evolution of this business model. But how would you define this moat for Amazon?
No, I think it is incredibly wide. I think it's because of like the corporate culture there. Jeff Bezos and now Andy Jassy, like I said before, they are one of the few companies, they are not afraid at all to spend as much money as they need to dominate an industry. A lot of companies are hesitant. They don't want to leverage their balance sheet. And thankfully, Amazon has so many cash flows and such a good cash position. They don't even need to really use debt to do this. But a lot of management teams, they're thinking quarter to quarter, man, we got to hit these profit numbers. We got to grow our earnings, et cetera. Amazon doesn't care at all about that. What Amazon cares about is, like you said, dominating an industry. Whatever they want to do, whether it's cloud, which they do, they have the number one cloud, AWS, chips, AI, they're getting into that. Whatever it is, I have total confidence that they're going to invest as much money as required to dominate it. And they have the money and they have the willingness to do that. So that's what sets them apart, I think, from most other companies. They have a very long-term mindset, whereas, half the S&P, if not more, is every quarter, they're just worried about hitting their numbers. Amazon doesn't care about the numbers, so they don't have to worry about that.
Great. Well, Nick, thank you again. And thank you everyone for watching. Please drop us some comments below. Nick or I are happy to answer any questions you have, and look forward to seeing you next week. We'll be back again here for the wide-moat Show. Thanks for watching.
Thank you.
Thanks for watching this episode of the wide-moat Show. Please like and subscribe below. And also, please join us at the wide-moat Daily for our dose of daily news. You can visit us at wide-moatdaily.com. Thanks for watching us. Have a great day.